Stocks had a big move today. We can note we have a lower low, we have a higher high, which gives us a bullish engulfing candle. And we also closed at a new record high, which means a new record closing basis. So what exactly did Jerome Powell have to say to make stocks go higher? Or is there something else at play? Remember, Jerome Powell speaks today, and then to close the week out, notably on Friday, we're going to be getting average hourly earnings, non-farm payroll, and the unemployment rate. But first, since this is the last day of September or the last day of the month, right? Last day of the quarter, have a look here because something's happening. It's called window dressing. Window dressing is a short-term strategy used by companies and funds to make their financial reports and portfolios look more appealing to clients, customers, and investors. The goal is to attract more people and more money, hopefully boosting the next reporting period's bottom line. What does that mean? Why was Amazon red today and why was Apple up? Because in the last 3 months, Apple did well. If we go here to no group, we look at the Magnificent Seven. 1, 2, 3. Those did well. 3 or not. And Tesla's actually green. So what do people want to do? They want to pretend like they own the good ones. They want to pretend like they own this the whole time. That's why they're buying Apple aggressively today. It's the same reason why they're not buying Micron today, right? Oh yeah, we never owned that one. That's called window dressing. So what we have to really remember is that Jerome Powell talking today, it moved the needle, but not really all that much. Here are the headlines that Jerome Powell actually said just before we have a look at the video here. Actually, let's play the video first.
Broader economic conditions also set the table for further disinflation. The labor market is now roughly in balance. Longer run inflation expectations remain well anchored. Turning to monetary policy. Over the past year, we have continued to see solid growth and healthy gains in the labor force and in productivity. Our goal all along has been to restore price stability without the kind of painful rise in unemployment that has frequently accompanied efforts to bring down high inflation. That would be a highly desirable result for the communities, families, and businesses we serve. While that task is not complete, we have made a good deal of progress toward that outcome. For much of the past 3 years, inflation ran well above our goal and the labor market was extremely tight. Appropriately, our focus was on bringing down inflation. By keeping monetary policy restrictive, we helped restore the balance between overall supply and demand in the economy. That patient approach has paid dividends. Inflation is now much closer to our 2% objective. Today, we see the risks to achieving our employment and inflation goals as roughly in balance. Our policy rate had been at a 2-decade high since the July 2023 meeting. At the time of that meeting, core inflation was 4.2%, well above our target, and unemployment was 3.5%, near a 50-year low. In the 14 months since the July 2023 meeting, inflation has moved down and unemployment has moved up, in both cases significantly. It was time for a recalibration of our policy stance to reflect progress toward our goals, as well as the changed balance of risks. As I mentioned, our decision to reduce our policy rate by 50 basis points reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate economic growth and inflation moving down sustainably to 2%. Looking forward, if the economy evolves broadly as expected, policy will move over time toward a more neutral stance. But we are not on any preset course. The risks are two-sided, and we will continue to make our decisions meeting by meeting. As we consider additional policy adjustments, we will carefully assess incoming data, the evolving outlook, and the balance of risks. Overall, the economy is in solid shape. We intend to use our tools to keep it there.
All right, so those were Jerome Powell's prepared remarks. However, when he's doing Q&A, we often get a lot more insight, which means that here's the key takeaways from his talking. Just first, if you guys don't mind, please considering to smash a thumbs up or subscribing to the channel. I would greatly appreciate that. Thank you ahead of time. Powell says housing inflation to take some years to cool. Whoa, some years. That doesn't sound encouraging. Powell says Fed not in a hurry to cut rates quickly. Okay. Fed will move over time to give more neutral stance, he says. GDP revisions remove downside risk for the economy. Yep, we're currently at 3.07 for the third quarter. I would agree with that. And then finally, central bank chief says policymakers will focus on the totality of the data, right? But what about the totality of the data? Exactly, Jerome. Glad you took that word, right? Oh my goodness. So what does all this mean? Remember, we just talked about window dressing. So what could be happening here? It could just be some good old-fashioned window dressing with what? The goal is to attract more people and more money, hopefully boosting the next reporting period's bottom line. What does that mean? It means end of the year. That's 3 months away. So here's a couple of quick takeaways, and then we'll look at a couple of quick charts because I think I captured most of this on the weekend video. One potential worry for the October, right, with the EAR. S&P returns when we're up by more than 50%, sorry, 20%, not 50, into the fourth quarter. On average, negative 3%. The median, negative 2.5. The highest percent, 22. So on average, we're down into October and then higher. Isn't that exactly what we talked about here for the monthly pattern? Oh my goodness, it is. That's right. Because again, the last time this happened, right? We have October, right? There we go. October. Where's October here? October. There's the low of the year. October. There's a low of the year. October. This one's not the low of the year. We did get a bounce, but you get the idea. So what we're getting here is a different slice of data that tells us that on average, down into October, higher into the end of the year. Easy way to summarize that is right here. On average, the next 3 months after the first cut within 2% of record highs, on average, 2% higher the next 3 months, 4 and then 14%. You guys if you're bullish, you like these numbers. But as I look at this one here, again, on average, -3. In our system, the algo.com is looking for reversal signals. It sees SH, dog, and PSQ with current 3-week window of opportunities for us to go lower. $2 risk reward on SH. This one failed, but the alert's still due, right? It's primed. So what does that mean? 3 months will take us almost till the end of October. This on average means we go lower into October. But where are we by the end of the year? Higher. Where are we after that? Higher. 3, 6, 12 months out. That's exactly what I talked about on here. Bottom into October and the election because there's going to be uncertainty. Moonshot higher. So when moon? Might be time to moon right now. All right, that's it for today's video. So if you want to come hang out with me, you can do that at 9:15 a.m. tomorrow. If not, click the video on the left. And thank you so much for tuning in.